Hey, what's up guys? Welcome back. This is the second video of 3 videos, and in this video we're going to be talking about how I plan for the trade, whether it's using commons or options, and how we size our trades. And that's going to be, a very important topic on risk management. But if you missed the first 3 topics, just go to Fit Traders and search up Leveling Up with Schumer. And there in that first video, I went over how I use TradingView and how to set up some of the basic features that TradingView has in order to chart. We also go over the psychology and learning aspects of trading, which is very important, and how I scout for plays and what I look for. So if you haven't watched that, go out and watch that video first. But if you're here to just figure out how I plan for the trade and how I size for the trades, then yeah, stick around for this video. And in the third video, we're going to be going over entries and exits on specific patterns and monitoring your trades and reacting to new information. So without further ado, let's get into this video. Hey guys, in this fourth topic, I'm going to be going over how we plan our trade, whether or not it's through commons or options. And so I just want to go over, for me, I typically use commons most of the time, and there's very specific instances where I'll use options. So in my trading world, when I'm trading, I'm about 80% of my trades are with commons, and with 20% of my trades are with options. And that's with an account size that's able to take advantage of moves in a small percentage moves in blue chip stock, so I can go in with size, and that's an advantage of having a larger account. Now I understand people with smaller accounts, you might want to leverage that account, and you might take more options trades than commons trades, and that's perfectly fine. So that really depends on the conditions that you're working with, and there's no really right or wrong answer, but I think understanding why you'd want to take one trade or one vehicle over the other is the important part. And so we're going to go over why we want to take options over commons or commons over options, right? So that's in order to understand that, we really need to understand what are the advantages of each one. And a lot of people get into options trading and they get addicted to it because the amount of leverage you can get off of it is unreal. And so but then you get addicted to that kind of volatility, and oftentimes you forget, why should I be in an options trade where a commons trade is perfectly fine? So why would someone take commons, right? And why would someone take forego the leverage you can get with options? Because commons are easy to trade off of, and it's good for scalping. Typically the spreads on a commons trade is very minimal. Whereas an options trade, the options dealers might not give you a favorable spread. And so when you're scalping, that spread doesn't change, right? Whether or not you're scalping or you're swinging. So if you're only scalping a small play, maybe a 0.5 percentage point in move in the underlying stock, that's not good. But hey, look, if you're trading commons, it's easy. It's easy because usually it's a 1 cent spread or maybe 2 cent spread, depending on what kind of stock you're looking at. It's easy to with commons, it's easy to set a stop, whereas with options, setting a stop means sometimes that specific pattern hasn't broken out yet, because you could be losing on time decay, right? And when you lose on time decay, what happens when you set a stop? You get hit on your stop even though the pattern hasn't broken out. With commons, you can hold through chop. So exactly what I was explaining is, when everything's moving sideways, you can hold forever, seemingly, and just set a stop and walk away. And so that's the great thing about commons. And another great thing is that you could trade in extended hours. So if there's news or if a specific pattern's breaking out, you get volume, you can react to it in after hours. Whereas with options, you're kind of stuck holding the bag until the next day when the bell rings. But why wouldn't you want to use commons? And this is what I was explaining earlier in the video is, you might not have the amount of capital in order to maximize the move on a certain stock. So let's say if Apple, which moves 1 to 2% on a good day, is in a really tight pattern, you got a high conviction that it's going to move one way and you want to take advantage of it. Like, in order to maximize a 0.5% or even 1% move on Apple, you need quite a bit of money. Like to make $1,000 off a 1% move, you need $100,000 of Apple. And so how do you maximize that if you're really confident that 1% move is coming, right? So you'd want to use options. So let's get into options now. What are the pros? Obviously leverage, and that's what people are addicted to, the leverage in options. And but the other attractive thing about using options is you have a really defined risk. So whatever you're putting up is how much you're going to lose maximum, even if the stock goes 5 to 1 the other way, right? The most you can lose is what you put in, which is great because you look at a stock like Luckin Coffee that came up with fraud news overnight, and the stock tanked 75%. If you were in calls, I mean, you had unlimited gains going one way, and you have a defined risk going the other. Where someone who was investing in Luckin Coffee, someone who was swinging overnight, they would have gotten killed with a 60 to 75%. I think it was minus 75% over 2 days. And so that is why most people would want to use options, is because you have the defined risk and you have leverage on that risk. But what are the cons, right? And the cons is what really kills people here is your decay over time, and the complications of calculating what the risks to reward is, depending on it depends on so many factors. It depends on your delta, your gamma, your implied volatility, and so it's difficult to calculate your risk to reward when you're playing options. You're really counting on that volatile move, that impulsive move to the direction that you think it's going to go. Otherwise, if it goes the other way, right, like you could lose a lot more and you can lose a lot faster, let's say. So that's something we got to take into account is how fast is that move going to happen. And also with options, you got to figure out if that underlying stock is worth that volatility in the underlying stock is going to give you that payout. Because if the underlying stock is already moving like an option, let's say like recent stock is like TCAT, right? TCAT moves 10 to 20%, even 30% in a day. And so why do you need to play options if you can just go size up with commons? Like if you're not swinging, that is. Like if you're swinging, you got a bigger percent chance of having news come out overnight and getting killed like you would with Luckin Coffee. But if you're playing in an intraday pattern, if it's moving 10 to 20, 30% intraday, then there's no need to play commons, I think, or there's no need to play options. And with options, the spread is even wider. For something like TCAT, you're looking at the spread on commons, which is already 1 to 2%. If you look at playing options, the spread sometimes is even wider and your implied volatility is high. So the return on playing an option versus the risk you're putting up isn't really good in a lot of cases. So let's go over some options and what we can buy. And I know this is a specific member request and going over different multi-leg options. And I'm not going to go over every single multi-leg option, and I think the most common one is vertical spreads. But there's a few different ways we can leverage with options, and there's different strategies involved. But we can just regularly buy contracts. We could buy calls and buy puts, and with that you have unlimited profit potential, but you're limiting your risk, right? And you can write contracts. So with writing contracts, exact opposite of buying contracts is you're on the other end of the contract, where you're offering somebody else unlimited profits, but you're taking also unlimited risk, and you don't have defined losses. But why would someone write a contract is typically when you recognize the implied volatility is very high and it's unlikely for the implied volatility to get any higher. So there's a spike in volatility in the stock, and you're looking back at the historical volatility of a stock, and it usually isn't ever that high. So you might want to write contracts, right? But that isn't a strategy that's great for smaller accounts, because you easily blow up your account if, even if it's a 1% chance of that happening. That's a 1% chance you'll never ever be in a stock market ever again. So why would you ever do that? But there is a way to limit that risk by both buying and selling a contract of the same expiry, but different strikes. And that's what we call a vertical spread. Now, depending on whether or not you're buying a higher strike or buying a lower strike compared to writing a higher strike or writing a lower strike, that would be you're either selling a vertical spread or you're buying a vertical spread. For the instance, when you're buying a lower strike compared to when you're writing a higher strike, that's called buying a vertical spread. So you're betting that the stock's going to go up. But what's the upside to that? Like, why would someone buy a vertical spread versus just buying a contract, right? Whereas, with buying a contract, you have unlimited upside, but you also put up a lot more risk to get that upside. And sometimes, the contract or the price might not move very volatilely towards the direction that you're betting on, and that's why you would want to buy a vertical spread, is because it's almost like flipping a coin, right? You're betting on the direction. It's going to move that certain amount of percentage in that direction, and once it crosses a threshold, there's a break-even price. Once it crosses that break-even price on the vertical spread, you gain that amount of money, but you cap the amount of profits you can gain. You can also cap the amount of losses you lose. So I would call that more of like flipping a coin with buying a vertical spread. And if you want to learn more, like, I can't really explain all of the different multi-leg options here, but that's what I would compare it most to. You're capping your gains, but you're also putting up a lot less risk for getting or buying a vertical spread. And last on this page, we're going to go over how to choose a strike and expiry. So in order to figure out what strike you want and what expiry you want, you got to figure out what the price target is of the pattern you're playing, and when you think it's likely to get there. And a general rule of thumb on how I play options is I would, once you figure out your price target, you want to select the strike just under that price target. So you want some intrinsic value by the time it reaches that price target, but you also want some time left in that contract by the time it reaches that price target. So for instance, if I think, if Apple's $100 right now, I think it's going to move to 110 by next week. I want to buy a strike just under 110, so maybe 105 or 106, 107, but for 2 weeks out, right? Because it's going to reach 110 by next week, in 1 week. I'm going to buy a strike just under 110, so let's say 107, for 2 weeks out. And so what does that ensure? That ensures enough time for the play to play out, but I'm left with some intrinsic value, and I'm left with some time value in my option. So it allows me enough time to let that trade play out. If you don't allow enough time, and you don't allow, if you don't select the strike that's in the money, then you're really betting on a higher volatility move. And if that volatility doesn't come by the time that you choose, even if it moves in the right direction, you're going to be losing money on that contract. So that's not what I want. That's not the plan, right? So the plan is for it to hit a price target in a certain time frame. And so you got to really evaluate that price target, and you got to look at the time on the time frame on that pattern, and you got to compare it to how much time it takes for that pattern to usually play out. And that's something we're going to go over in the sixth topic is how we play different patterns, and what to use, what vehicle to use, options or commons. So the last thing, I think one of the biggest things to planning your trade is to figure out what the risk is. And risk is really how much you're putting up. And I think of it personally as a percentage of my account, right? So if my account was $100,000 on any given trade, maybe I'll want to risk $1,000, 1% of my account. And so what does that 1% look like, right? And that depends on the volatility of the setup that's happening and what my stop is. And that's really the most important thing, is how far do I want this trade to go the wrong way before I recognize my losses. And that'll depend on what kind of information you're getting as that chart is developing. And you might want to give us a little more rope depending on what's happening in the chart. So there's no really easy answer to that question. So, and it's something that we're going to go over on the sixth topic as well, is for different specific patterns, what is my stop, and how far are we going to let it go before we should call it quits, and perhaps even flip biases and go the other way, right? But yeah, with calculating your risk, you want to ask yourself, like, how volatile is a stock, and how volatile the stock is. So with my earlier example with TCAT, if it's moving 10 to 20, 30% a day, trading options probably isn't going to be a good choice, I think, because with options, it's already incorporating the implied volatility of the underlying stock. So the options contracts are going to be very expensive, and for you to profit off the options contract, it would need to move even more than what it was moving in the recent history of that chart. And so you got to calculate what the percentage chances of that happening, right? Whereas if you just play commons, you can play the 10, 20, 30% moves in that underlying stock. And so that's something to really figure out is, hey, look, do I really need to play options here? Can I just leverage off shares and get a pretty good profit off of just playing shares? So yeah, just ask yourself, hey, look, what's the recent volatility of the stock? And if it's volatile, just play commons. I think it's worth it. But the other question is, what if you're going to swing, right? If you're going to swing, then you maybe want to take some options instead, in order to mitigate some of the risk of holding a stock overnight. Second question to ask is, where's the stop? Where's the stop going to be? Where's the hard stop, right? Like if you're playing a triangle, you might want to use that last higher low or lower high, depending on if you're buying it long or short. And it may also depend on, hey, look, do you get volume confirmation, right? And so with that stop, depending on where the current price is and where your stop is, you got to figure out, hey, look, where's my maximum loss going to be? If I had $100,000 account, what's that $1,000 1% maximum amount I'm going to lose going to be, right? If the stop is very far away, you might have to go in with a smaller sizing initially. If the stop's really close, maybe you can go with a bigger sizing, right? Because the chances are, if you got a strong bottom channel or a bottom trend line, you got a strong top trend line, and you're really close to that bottom trend line, and you think it's going to bounce off of that, you might be able to risk a little more in order to you might be able to risk a little more and still have that same $1,000 risk that you're putting on. The next question I ask is where your price target is. So let's say with the previous example, and you're in a triangle, let's say a bull pennant, right? Which is a continuation play. Your price target is going to be the break of the new high. So, with the pennants, it comes to a high, then it gets into a triangle. Where's that high? With a continuation play, it should bull break more than 50% of the time because it's a continuation play, and you're going to get a new high. So where's that new high compared to where your stop is, right? Then you can figure out your risk to reward, because your risk is how much you're risking before your stop hits, and your reward is going to be breaking of that new high and potentially into another bull flag, and continuation of the trend. So that's going to be your price target. And to calculate your risk to reward, you just take your price target minus your risk, and you get the ratio of how much you're earning versus how much you're putting up. But the last thing is something I didn't include in this slide is what the probability is of a play playing out. So this is important because we want to figure out, for that risk to reward to even play out, that ratio to even be applicable is what's the probability of that play even playing out. So you're going to multiply your probability times your risk to reward in order to get how many times, or what the likeliness of it to make that reward. This is also like a primary reason why we want to play continuation plays, because they have a higher likeliness that skews towards you, and that makes it likelier for you your pattern to play out. Another question to ask is when you want to start taking profits and how much profits, right? Like, you don't always have to take all of it all at once. So my previous example with the bull pennant, you can take partial profits and try to let the other portion of that trade mature. When we let it mature past our intended plan. So your plan is you want to let a bull pennant play out, right? And it could be in a strong uptrend. So you want that uptrend to continue playing out. It could be, like I said, it could bull break out of a bull pennant, and then bull flag, and then bull pennant again, and then you just get flag after flag after flag. And the important part is you already took some profit, so that ensures your win. Now you can let the other half mature. I think a lot of people take profits and their entire profits way too early, but it's also impossible to, I shouldn't say impossible, but I think it's irresponsible to not take partial profits along the way and let the entire position mature. Because sometimes where you get a bull flag out of a bull pennant, you get a bull break out of a bull pennant, you'll start getting divergence, and that divergence might play out right away. So if you left the entire position on the table, and we get a bull break, and all of a sudden you get a bear break, what are you going to do, right? You're all of a sudden you let a good trade turn into a break-even trade or even a loss. So which is why it's important to take partial profits when your initial plan has played out. It's okay to leave a portion out to mature, but we have to take small profits along the way, and I think that's a responsible thing to do. So yeah, so I'll go over some real examples later in topic number 6, but before we get there, we're going to talk about sizing and how we size our trades. This is an important part of how we manage our risk. And this is also how people blow up their accounts and sizing inappropriately, both in commons and options. So let's talk about that first. See you in the next topic. Hey, what's up guys? Welcome back. And in this topic, we're going to go over sizing your trades. And I know there's, a lot of people want to understand hey Keith, how do you size your trades, right? My standard response is it depends. It depends on you actually. And for me, I size my trades based off my conditions. And my conditions as in, the size of my account, the experience I have, and recognizing the different setups that's happening. And all those factors are going to depend how I size, because that's going to determine, how much risk I'm putting up. But what is risk? What is risk? And that depends on a few things. So let's dive into it right now. So like I said, it depends on your account size, right? How you size depends on your account size. If you have a smaller account size, you might want to grow that aggressively. But that also depends. Even if you have a small account size, let's say it's $5,000, $10,000, how easy is it for you to, or I'd rather say, how hard is it for you to get that $5,000 back? How do you save that $5,000 back? If it takes you a year to save that $5,000 back, you might want to be a little more careful with that $5,000. You might not want to size that aggressively because, if you blow up, it's going to be another year before you can trade, right? So you shouldn't be as aggressive. But hey, if it takes you a month or two to save that $5,000 back, maybe you want to be a little more aggressive, right? You want to take a little more risk. So that's one factor, your account size, and how long does it take for you to gain that account back. If it's $100,000 account, you know, not everyone can make $100,000 in a year, let alone save $100,000 in a year, right? So you want to be a little more cautious when you're taking, or when you're sizing your trades based off a $100,000 account. There's no simple answer. So you got to figure out what that risk is you're taking on, and you know what your trade strategy is. How do you want to grow your account? That's one factor, right? The second factor is how confident and what the conviction is in your trade. And that really depends on your experience and the amount of time you have in the market, what kind of edge you have in the market. And the third one is what is the ticker volatility? And so with your ticker volatility, you have to look at, you know, what the historical ticker volatility is. You know, Apple might move, you know, it's rare for Apple to move 10% in a day, yes, and you're going to see Apple move 10% in a day. But, you know, what's the historical volatility of Apple? It's 1 to 2% usually. So I think with all those things, you gotta figure out, you know, what is your experience level, what's your account size, times what is the volatility of the underlying ticker. And those are the three things that you should consider when sizing up for a trade. So what is our goal? And as a trader is how do we maximize our profits by sizing correctly? And for me personally, when I see a trade and I have high conviction in a trade, I size up. I size way up. And I say this to a lot of people is when I make most of my money off of just a handful of trades. The other 10%. So I make 90% off of 10% of my trades, and I make 10% of my profits off 90% of my trades. What does that mean? That means, you know, I literally am sitting around looking at the market. Most of the times I'm just sitting here watching the markets, taking small trades here and there, and I'll get cut up maybe. But when I see the good trade that comes, the one that I have high confidence in knowing that it's going to move one direction, I'm going to size way up, because that's where I'm going to make all my money. And that's the one trade I've been waiting for. Like, it could be weeks before I get that trade. But yeah, all the other trades are just, it doesn't really matter to me, because like I'm sitting here, I might be bored, right? I might take a small trade, I might take a small little cut here and there, or I might make a lot of small wins. And you know, those small wins, yes, do add up, but the bigger wins are the ones that count. And so our goal as a trader is to size up when we have very high conviction. We use regular sizing when it's just a regular size confidence trade, and that will depend on your experience. It's to understand, you know, what is a high conviction trade and what isn't a high conviction trade, and how to size appropriately. And here I got two questions. So you got to ask yourself, what is a high conviction trade? That will depend on you, and that will depend on your edge on the market, your recognition of what you think is a high confidence trade. And the more experience, the more time you sit here staring at the charts, you're going to understand what is a high conviction trade. Because the more conviction you have in a trade, the more you're able to let it mature, the more you're able to let that plan play out, and the more you're able to size up without, and this is the key part, was without having all those emotions that we talked about in the psychology topic looming over you. You don't want to have hope. You don't want to have fear. You don't want to have regret. You want to have greed. All those things. You want to be able to be in a trade in full control, understanding exactly how this chart's going to play out. And you know, once you have that conviction, you lose all those emotions. And you'll know when you get into that type of trade. It starts off with one type of trade, right? Once you get an edge on the market, you have one type of trade you're confident in. You know, you start working on that. You start adding to the variety of trades that you have high conviction in. And so when I say that's the difference between your high conviction trade and your regular conviction trade, is you might start off with one high conviction trade, one pattern that you're really good with. And you got all these other patterns that, you know, you're kind of like still dangling over and you're still trying to like work things out, right? So those are regular confidence trades. And so the other ones you might get chopped up on. That's fine. But as long as you got that one good confidence, high confidence trade that you could take once in a while, that's good enough to get a high return, because you size way up on the high conviction ones and your size smaller, much smaller on the regular confidence trades. And that's how we keep our losses small and we extend our profits. A lot of times people sized equally in every single trade. And that's how you get chopped up in the market, is because, on the high confidence trades, you're not sizing up. And in the irregular confidence trades, you're not sizing down. Why are you sizing the same on every single trade if you're not really confident in it, right? So that's one thing to think about. So remember, I talked about three different things here. You got your experience, your account size, your volatility. So first thing is we're going to talk about experience. And, I kind of came up with this leveling system on your experience. And yeah, let's get into it. So you got to understand your experience before sizing up on your trades. So how much time do you have in the market? How much time do you have staring at the market? And how much experience do you have in different setups, and how you're playing with those setups? And so your experience depends on is going to determine how comfortable you are in a trade. The more comfortable you are in the trade, the less emotional impact you are going to have in a certain trade. You don't want those emotions flaring up, because once you start sizing up, the emotions start to creep in to your trade. And when those emotions start to creep up, you're going to lose control of how you're going to manage that trade. And so the goal is to not have those emotions flare. How do we not have those emotions flare? Is to understand the setup that you're in and understand the maximum size of the trade you can have, that you can be in. And another thing is to have an edge on the market. And what is an edge, right? Is when you're able to recognize a particular setup and execute a trade plan consistently. I'll read all those words again. This is really important. Is to be able to understand that the setup that you're in, and to be able to play that trade, or be able to execute your trade plan consistently with high confidence, and you understand where, or the high probability of where that setup is going to head to. So we got our different experience levels here. So you got to figure out which one you're in. Experience level 0. You're new to trading. You don't have a lot of TA experience, and you don't have an edge in the market. So where do you got to work? You got to start, learning the TA, start having a little more time in front of the charts, understand the different patterns that are setting up, recognizing different patterns. If you can't even recognize the patterns, you're not even going to be able to understand how to play those patterns. And so the first thing you got to do is just work on your TA. TA is not hard to learn. It's hard to apply. It's hard to manage your trade around the TA. So if you're experience level 0, hopefully you're not playing with hundreds of thousands of dollars, because that's a lot of losses you're going to incur trying to learn TA. I always recommend size down to begin with. Make that your tuition account. You're going to pay tuitions to the market. Now, how much the tuition is going to depend on you, but I recommend starting off with $10,000 account, $50,000 account. And start gradually. Once you gain that experience and you level up, increase your account size once you get that edge on the market. So experience level 1, you still don't have an edge on the market, but now you got a good to great understanding of TA. And when I say good to great understanding, you're able to you start recognizing the patterns. And once you start recognizing the patterns, you're able to start playing them, and you're trying it out, right? You're trying it out until you're trying it out so that you can get an edge in the market, but you still don't have an edge in the market. So I think that's experience level 1. And that's the main difference between 0 and 1 is, one guy doesn't have a good understanding of TA, and the other guy has got a great understanding of TA. And that's the main difference between 0 to 1. And once you get the 1, you get a great understanding of TA. You're gonna work from 1 to 2, level 1 to 2, and you're gonna have some edge on the market. So bull flags, for instance, right? Or bull pennants, bear flags, bear pennants, cup and handles, wedges. So once you start having one or two plays that you can consistently rely on, and you can, that's when you have an edge in the market. You can consistently leverage off these different patterns and make money off of them. The other patterns, you might start, you're still dabbling in them. You don't really have an edge over those patterns yet. But once you have one or two, I think you're starting to get into experience level 2. It's because you're able to, reliably size up on certain plays and make a lot of money off of those. Now, the market's going to offer opportunities. It's going to be in cycles. So, those plays are going to come and go. And the amount of those plays are going to come and go. But, that all depends on how much you can sit in front of the market and recognize those plays. And then when those plays do come around, you're able to maximize your edge on those plays. And once you get to that level, you're level 2. And so this is, I think, once you're at level 2, you're able to start, really being a profitable trader. Most of the people will spend most of your time, in levels 0 and 1. And a lot of people start giving up because you lose a lot of money from getting from 0 to 1 and then from 1 to 2. The amount of time you spend in the market, the amount of time you stare at the screens, the amount of money you lose trying to learn, the amount of frustration you go through. And it's really in those first 2 levels. And to get to the second level is where you start being profitable because you have an edge in the market. And so once you get to level 2, it's really when the fun begins, is you're able to just sit around and wait for those good setups to come to you. And once those setups come to you, you start making money. And so you're able to stay in the game for a lot longer, and you're able to start, building your skills and gaining an edge on the other setups that are happening. And that's when you get to level 3, is when you're able to almost pretty much leverage off every single setup that is out there. And you can figure out a plan on how to maximize your risk, how to size up, when to size up, when to add, when to remove positions from the market. You don't only just go one position into a play and one position and taking the entire position out all at once. You start making, 1 entry, 2 entries, and then you start taking out a portion of your profits, and you take out your second portion of profits, even third portion of profits, right? Once you start learning how to do that, I think you're at level 3, and that's going to be you're going to be at the top of your career, and you're going to stay there because once you get that experience, you're not going to blow up your account because you know how to size correctly. You know how to manage your risk, and even if a recession comes around, or there's going to be one day where you're in a trade and the company's going to flip belly up. Right? You're going to have managed that trade based off the best experience you have. So a previous example I had was Luckin Coffee. Like my learning experience from Luckin Coffee is when you're playing a name that's not very familiar to you, even though it's very, you got high volatility in the underlying stock. Luckin Coffee was moving 10-20% in a day. My learning experience from that was, hey, look, it's better to, if it's a company that you're not very familiar with and you don't know much about, it's probably better to swing options overnight versus swinging a large commons position. And so, that's not something you can control, but you also can't go all into those positions because it could kill you overnight. And so that's one of my biggest learnings from that. But yeah, like once you get the level 3, you've managed your risk such that you will not blow up overnight. And not only that, you won't even lose 10% of your account overnight. And so all these different levels of experience really is about a testament to how you can control your risk and the amount of plays that you're comfortable with. So you can take a look at that and see like, hey, which level you're in. And so when I talk about experience, an analogy is I always like to use is with poker. And for those of you that understand poker, it's not hard to tell like which poker hands are good hands. And so that is an analogy to technical analysis. with technical analysis, your entire trading career is trying to, a big portion of your trading career is trying to understand what patterns are good patterns to play. That's the same thing with understanding what hands are good hands to start off with in poker. Right now, that's only one part of the problem. Like one part of learning how to trade well, one part of learning how to play poker well is understanding which hands are good hands. But even once you understand which hands are good hands, that's not enough. That's not enough to get you to become a profitable trader or a good poker player. What's a good poker player do? Well, you play the good hands, right? But once you start playing that good hand, when that flop comes out, when that turn card comes out, when you get new information, how do you react? How do you adapt to that new information? And that's what makes you a good trader. So you're in a good setup. You got pocket kings. And you're going to play, right? You raise the stakes. I'm going to size up. You size up. That's fine. That's great, right? But let's say the flop comes out ace, queen, 9. Highly connected board. Ace is out there. So anyone with an ace is beating you already. You got pocket kings. How do you react to that, right? And you could possibly be losing at this point, and you got a lot of money on the table. When do you cut your losses? When you recognize that new information is against you. And that's really a testament to your experience, to managing your risk. Because the same thing with playing in a poker tournament, you want to be there for as long as possible. You don't want to blow up, because once you blow out, you're out of the game. You don't want to be out of the game. So this next part, sizing your trade, is your account size, right? And so you really got to ask yourself what your growth plan is. Like I was talking about account size earlier. So you got a $5,000 account. How long does it take for you to save that $5,000 back? If it takes a long time, you might want to really use that $5,000, depending on your experience level, right? It's going to be your tuition account. How do I stretch that so that you get the most out of the learning out of that with that $5,000 account? I'm going to tell you right away, if you're new to TA, you're not going to be making a lot of money on that $5,000 account. So, don't blow it up right away. Try to learn with it. Try to see what works, what doesn't. And if you're going to make a lot of money off of it, I think it's with as a new trader, it's usually luck. And I'm going to tell you right now, there's going to be a lot of people that are lucky. You run into a hot market, you buy something, it's going to go up. You go into a $5,000 all-in options trade, it's going to go up. You're going to make $10,000, $20,000. But if you don't sit down and try to learn and see what works for you, what's your edge on the market, you're going to lose that $20,000 back real quick. So with my examples here, with smaller accounts under $100,000, I think, some people might want to have aggressive growth. With mid-range accounts, like from 100,000 to $1 million, you might want to have moderate growth. And for larger accounts, because you have such a large account already, you don't need to grow that account that rapidly. So you might want to just have light growth. But again, you got to take this with a grain of salt. It depends on your experience in the market. If your experience in the market is, you're brand new, what the heck are you doing with $1 million account? If you're just going to lose it all back to the market, that's a lot of money for a lot of people. And so if you're playing with if you're new to trading and you got even $100,000 account, right? That's a lot of money. It's a lot of tuition fees you're potentially going to be paying to the market to learn how to trade. I recommend sizing way down and just trying to learn with a much smaller account. Anywhere from $10,000 to $20,000 is a good size to start off with as tuition, and you want to make that $10,000 to $20,000 last as long as possible. But let's say hey, look, you got a $10,000 to $20,000 account. You got an edge in the market now. You're really good at trading, one or two different patterns. Hey, look, be aggressive when those plays come, right? And you want to leverage off of them. You may even want to take options trade off of those and get those 100% plays. But you don't want to go all in, right? You don't want to risk everything on an options trade that could potentially go south only to lose 50% of your account back. But so when you're in an options trade, you also got to figure out, hey, look, how much do I want to risk? What's aggressive but won't put me at risk of not trading tomorrow? That's something you want to ask yourself. So with sizing your trades, you also got to look at the volatility of the underlying stock. And I talked about this earlier, and you want to look at the recent historical volatility. And so what is that stock moving? How many percentage points? The more percentage points that is moving in the underlying stock, it becomes less appealing to play options, because if the stock's behaving like an option itself, it's moving, 20, 30, 50% a day, right? Why do you need to take options trade? Why do you need to take an options trade? The underlying stock is moving like an option. The only reason why you want to play in options is to leverage the underlying move in the stock, and potentially, place a maximum risk to the trade. So this is something to ask yourself: is how do you size your trade if the recent historical price volatility was 1%, if it was 10%, if it was 50%? How do you size your trade? And do you go options or commons? And so you should be able to figure that answer out now to this question based off of everything I've said in topic number 4 and earlier in this video. You got to consider that if recent price volatility was high, implied volatility is going to be very high. And because implied volatility is high, the options contracts are going to be expensive. And the more expensive the options contracts are, the less likely it is for you to have a profitable risk to reward ratio. Because even if the underlying stock moves the direction you think it's going to move in, it might not be enough or fast enough for your options to be profitable. So you got to take that into consideration as well in sizing your trade. Like with options, you might not make any money off a certain move. With commons, you will, because once that underlying moves, you'll either be in the red, you're going to be in the green. So like I said earlier, like my Apple example, if your account's $100,000, it might be okay to go in Apple all in. Because Apple only moves 1% to 2% in any given day, and you don't have that kind of risk with Apple going bankrupt or having fraud overnight, right? Apple's been around for such a long time. The products are great. If it's a company that you're not fairly familiar in, then you don't want to be in that kind of large trade. But the companies that you aren't very familiar in are also the companies that likely will have high volatility moves. So you got to figure out what the risk is you're putting up. Yeah, that's exactly what I'm saying. You cannot size the same in commons in Apple as you would in GameStop. So understand the risk you are taking on with the recent historical volatility. So that's exactly what I'm talking about in this last 5 to 10 minutes. So yeah. So I think the question I get asked very often is, what defines your full position? Keith, what's your full position in a trade? And I'll get into a trade, and when I'm sizing into a trade, I usually size in multiple entries. I'll get into a 1 of 2 position or 1 of 3 position to start off with. And this really depends on if we're tightening inside a pattern or if we're already breaking out of a pattern. And so, if we're already breaking out of a pattern, we're getting high volume, we're getting direction, and we're getting increasing volume candles, I might be sizing in a full position right away. But if the pattern's still in a tight range, so let's say a triangle or a pennant, and it's bouncing in and out of the pennant, you're converging, and we're starting to near the apex, I'll get into a half position inside the consolidation. And that gives me a really clear stop. But why a half position? I get into a half position because that decreases my amount of risk that I'm taking if that stop hits. And so, but what happens when the price moves in the direction I think it's going to go in? and we get a bull break, right, of a bull pennant, then I'll add to that position on increasing volume on the break of the upper trend line. And that maximizes the amount I will make in that trade because I'm getting confirmation of the bull break with volume. But I put up a lot less risk because, you know, I'm already getting confirmation of the one direction move, and I'm putting up a lot less risk for that half position that I had on prior to the breakout. So that's my full position. But, you know, what's the full position in relation to your account size? And so that, again, we got to go back to, you know, what is your account size? What's your experience in the market? What's your experience level in the market? And what's your edge on that specific play? Your confidence level, right? The moment you size up and you size beyond what you're comfortable with, those emotions start coming in. You might have taken your entire profit out way too early, right? And you're going to be kicking yourself later on saying like, why did I take it out? There's no exit signals. There's no exit signals telling me I needed to get out. So I can't tell you what the full position is because that depends on you and your experience level in the market. But I can tell you like what I do is I'll look at, hey, look, what is that 1% loss in my account? And that's what I'll usually take as my maximum loss, 1 to 2%. And that's already in a very high conviction trade. I might even size up beyond that if it's a really, really high conviction trade and I know it's gonna go a certain way. And that's in very specific patterns like oversold bounces and bull flags that are almost perfect. Yeah, so, but that depends on you. That depends on your experience in the market. You know, I'll never risk an amount where I can't recover from. So if my risk, I can't risk like 10 to 20% of my account on a single play. Because recovering from let's say a 20% in your account, a 20% loss in your account, that requires, you know, if you had $100,000, you lose down to $80,000. That's a $20,000 loss. In order for you to get from 80 back to 100, that's a 25% gain that you need. So a 20% loss, but you need a 25% gain to get back to where you were. That makes it a lot more difficult. And for another example, if you lose 50% of your account, that's a 100% gain you need your account to get back to where you were. So you don't want to risk too much, right? Like, so it's a marathon, and it's not. You're not going to retire tomorrow. You don't want to trade like you're going to retire tomorrow because you're putting on way too much risk on yourself. You know, the difference between retiring and going bankrupt. So this is what I've been saying right here. Everyone will size differently as a percentage of their account, depending on their experience level. For example, size based on how comfortable you are given your experience, and size of your account and how aggressively you want to grow it. So you got to sit down and think about those things and how you want to grow your account. What kind of level of risk? You know, a lot of people don't think about that and write that down on a pen and piece of paper if you got to remind yourself every day on how much risk you want to put up. So yeah, thanks for watching, and stay tuned for part 6 of this.